Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Kevin Davitt, head of index options content at Nasdaq, to discuss some summer trading activity. Kevin, it's great to see you as always. Welcome back to Trade Talks.
Good to see you too, Jill. I'm excited to be back.
To what extent is this a normal summer market?
That's a question I like a lot for a couple of reasons. Big picture, I like working in capital markets because I think they operate, or in many ways mirror life in general, in the sense that there's ups and downs, there's periods of real uncertainty, and then there's also time frames where life or markets are fairly predictable. There's also seasons in the sense that weather changes, and in markets, we have a handful of months that we refer to as earnings season, and that's the case right now. So there's all sorts of overlap, and I find that compelling. So going back to your question, is this the normal summer market? From my perspective, the short answer would be yes. And keep in mind, I'm speaking very broadly, but equity markets typically perform well in summer, albeit with low realized and implied volatility. And that's exactly what I've been observing over the past few months. So the visual on the screen shows the performance of the Nasdaq 100, the Russell 2000, and the S&Ps since May of this year. The NDX, so the Nasdaq 100, continues to outperform over the time frame that we're looking at here. The Nasdaq 100 is up about 20%. That's a big move. The small cap's up about 15%, and the S&P is up about 11%. Now, relative to history, this year overall has been particularly strong in terms of price performance, but it comes on the heels of one of the worst years in a long time. So it is great to see the rebound. As I mentioned, we're kind of in the middle of earnings season. This week, about 40% of the NASDAQ 100, when you're looking at it in terms of market cap, reported their quarterly results. By and large, that was very positive. The market has responded and kind of continues to advance into the end of this week today. The last similarity is that realized and implied vol levels continue to grind lower. That too is very typical during the months of June and July. Volatility measures do typically bottom in August, and I will keep my eye on that looking out another month.
So let's dive a little bit deeper into that point, right? What's going on with macro volatility lately, and what might that mean for the end of the year?
You know I love talking about volatility, as do a number of your guests. So from a framing perspective, when you consider volatility, your time frame is always going to matter, as well as the underlying that you're looking at. So I'm going to focus on equity indices because that's my sort of line of work. And I'm going to reference 30-day calendar windows. So essentially a month, which is fairly typical. So point one would be that the NASDAQ 100 historically exhibits higher realized and implied volatility measures than the S&Ps. We continue to see that this year. 30-day, so that calendar month, realized volatility in the NASDAQ 100 running around 15%. Keep in mind that's an annualized number. It is the lowest measure for 30-day realized vol since November or December of 2021. So just a brief translation there. Lowest 1 month realized vol in more than a year and a half. Shifting, if we shift our focus to implied vol, which is a forward-looking estimate of how volatile an index or an underlying reference asset might be over the next month, NDX 1 month implied vol is right around 17. So a slight premium to the realized, that's normal. But it's also very near the lowest level since late 2021. That landscape looks very similar in the S&Ps, with 1 month realized around 9.3%, 1 month forward vols around 10.7. Both of those measures are near the lowest levels in about 20 months. So last point here, we often observe lower than average volume during the summer month for options. And I'm really excited to point out that the month of July that we're going to bring to a close on Monday is likely to close with NDX average daily volume at the highest level in many years. So I consider that super exciting. I expect, again, to this point about looking out to the end of the year, I expect we'll continue to see strong volumes and the prospect for kind of wider trading range when summer gives way to fall.
So what do you think is driving the NASDAQ 100 volume trend?
Just to be perfectly frank, there's never going to be a definitive answer for full volume attribution. So this is my take. I think that there are more institutional and individual end users that are looking for exposure to the Nasdaq 100 as opposed to alternatives. The composition and the performance of the Nasdaq 100 is compelling for, I think, a broad swath of the population. I believe that end users of all types value alternatives. And I think the NASDAQ 100 is being viewed differently at like a collective level. People know that there's a very high correlation between the S&Ps and the NASDAQ 100, but the makeup of the NASDAQ 100 is skewed in favor of the firms that end users, in my opinion, generally want exposure to. That historical moniker of the technology index used to have kind of a pejorative connotation, but it happened to be a glimpse into the future. And in my estimation, that's going to continue to be the case. So I think tech is the backbone of the global economy in the 21st century. And I understand that that kind of sounds like marketing fluff, but it also happens to be true. And the same types of strategies can be effectively employed, or that are effectively employed in other index products, can and are being executed in the NASDAQ 100. I would point out that the notional coverage for one contract in NDX is essentially 3 times the size of one S&P contract. So to see average daily volumes around 40K in July is super exciting. It's worth noting, and I've mentioned XND previously, but that's a much more approachable product that tracks the NASDAQ 100 from a notional standpoint. The coverage there is about 15K, which is 1/100th the size of the full NDX. And I think many individual traders are inclined to use a product of that size for exposure and the unique benefits that are associated with index products. Broadly, and wrapping up here, the risk management and the retail trading community has taken note. They're shifting some flow, and it's resulting in an incredibly deep pool of liquidity across the NDX products.
Right, certainly encouraging to hear. Appreciate the insight as always, Kevin. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.